Hi, it's Dre Griggs of Sitting Wisdom. Today we answer the question, why is looking at cash flow an important step in a good financial plan? When it comes to creating a financial plan, it's very important to understand not only what we're trying to accomplish, like the goals that we have set for ourselves, not only how much we need to save or how much our returns need to be in our investments. Sometimes we just need to know whether the number is good or not. And having a cash flow statement is a great way to be able to figure out whether your numbers are good. And what I mean is, if you look at the stock market, if you're going to figure out a good stock to invest in, 9 out of 10 times, you're going to be looking at things called ratios. You're going to look at their PE ratio. You're going to look at their current ratio. You're going to look at just how much money they're generating, their profit margins. You're going to look at all these different numbers, all these different ratios, and it's going to help you determine whether the numbers are good. Because a company making $1 million is one thing, but if you're making $1 million but losing 2 million, you're going to be like, well, dang, that company's not doing very well. If the company has a profit margin of, I don't know, let's say a company has a profit margin of like 5%, but if you just looked at the number by itself and they're like, hey, our profits are $30 million, you'd be like, well, dang, you got $30 million. Is that a good amount of money? Well, no, if your profit margin is 5%. But then you may say, well, Dre, that's technically a good profit margin if you were in maybe like transportation with logistics, like trucking companies, their profit margins are pretty small. If you were dealing with, maybe like grocery stores, their profit margins are generally pretty tight as well. So sometimes it even matters what industry you're in, whether the profit margin is any good. I guess what you're getting at, or at least what I'm trying to get at with you, is we really don't know what a number is without knowing what the number is. And to understand your cash flows, it helps you to be able to use different ratios to give you benchmarks to understand whether you're doing good or not. And I'm going to share a few of them with you today. And I'll probably share the Excel that I use when I'm coming up with people's cash flow statements and things like that. And I will go through them. The first one, and one of the most common ones, is called your savings ratio. Your savings ratio is just your personal savings and any employer contributions divided by your annual gross salary. You want to be somewhere over 10%, right? Just generally speaking, if someone is saving over 10% of their income, then they're doing a pretty good job. And that 10% could be with you giving, 6%, and then maybe your employer matching 5%. So you're at 11%. That's totally fine. Now, granted, most employers don't give that amount, so it doesn't really work that way. But what I do want you to understand is you're able to figure that out. All you have to do in your cash flow statement is to take whatever your personal savings and employer contributions are per year, and then you divide that by your total salary, whatever your gross salary is. So if you make $100,000 a year and you save $10,000 a year, then you're at that 10%. So you're saving a good amount of your money. But if you made $1 million per year and you saved the same 10%, well, now you're just saving 1% of your salary. So you're not saving a good amount. And that's why the cash flow statement is so important, because you're able to figure out the ratios, the percentages. So I can relatively say, this is good for you. You're saving 10, 20% of your salary. You're doing a good job. That's a good amount of savings. Or I could say, hey, you're saving 5, 6% of your salary. That is a good starting point, but we want to work our way up to getting over 10%. Because at the end of the day, whatever financial freedom looks like for you, if you just want to retire at 60 or if you want to retire at 30 or 40, you have to be able to generate a certain amount of income to cover your lifestyle. You're not as likely to achieve that number if you're only saving 5% of your income, because at some point in time, you're going to be living 100% off of the returns of your money. And realistically, most experts will say you want to be somewhere around 80% of your income. Now, there are some people that want to maintain the exact lifestyle that they have when they're working. So then we need to be able to generate 100% of your income. Other people I know where they'll say, you know what, Dre, I want to have a lifestyle that I do all the amazing things that I was never able to do when I was working. And that's more expensive. So we actually have to put a plan together where they are saving 120% of their income. But it's very unlikely that you're going to be able to get that amount of money if you're only saving 5% of your income. Now, unless you're willing to do it for 30 or 40 years. I can show you a plan where you give me $5 a day, about I forget what that is. I think it's about like $100 a month, maybe $150 a month, and you'll be around $1,800, under $2,000 for sure a year. And if you take the normal stock market returns of around 8 to 10%, you're going to be able to have over $1 million. You will be a millionaire, and you'll have the ability to purchase your financial freedom. And so it's definitely possible if you have the time. But most of us, we're usually trying to figure this out a little bit later. So the first thing is we're trying to get out of debt. And then the second thing we're doing is we're trying to free up the money so that we can then invest it to buy our freedom, to make that shift in our lifestyle. So for most of us, we're trying to put a plan together where we can achieve that goal in 10, 20, 30 years. So we usually have to invest more than that 5%. So that's why 10% is normally the good number. The next ratio that you can use your cash flow statements to calculate that would help you make a good financial plan is your long-term debt coverage ratio. So when we say our long-term debt, we're normally talking about debt that takes longer than a year to pay. For most people, that's going to be their mortgage, student loan payments, your automobile payment. Now, some will also capture their credit card payments, and what they'll do is they'll say, okay, if I was to pay my credit card payments for a year, then that portion is going to go in my short-term debt. But anything that I would be paying my credit cards longer than a year, I'm going to put that in my long-term debt. So what you would do is you would take the long-term debt, so that's anything that's over a year, and then you would take your annual gross salary, and then you would divide it by the annual long-term debt payments that you have. So the payments is what you'd make in any given year. You're looking to have a long-term debt ratio greater than 2.5. And what that means is you can take 1 year's salary and you can make 2.5 years worth of payment on your long-term debt. If you're over 2.5, then you have a good financial plan. You're in a good financial situation. It's just another kind of like a hack where you can use your cash flow statements to see how well you're doing. Are you allocating the right amount? Do you have enough income that's covering 2.5 times your long-term debt? If it's less than that, that means that you're kind of not looking good as far as your financial situation. You're having a little bit too much debt and you want to get the number down. Ideally, you either will make more or you'll decrease your debt. The next one is your debt to income ratio, and you guys have probably seen that in lots of places. If you've ever tried to finance a car or finance a mortgage, they always are talking about your debt to income ratio. You would want to have it less than 15% as far as having a good financial plan. And what you would do is you would take your annual consumer credit card payments and then you would divide that by your annual after-tax income. So if you have a cash flow statement, you would take your gross income and then a few lines down, you should have whatever you paid in taxes. You would subtract that, and then that would be your after-tax income. And then you would take the amount of your credit card payments, which would also be in your cash flow statements. They'd be on the outflows as well. And then you would be able to say, okay, if I make $100,000 a year and I pay $10,000 in taxes, so I'm left with $90,000. And then if I have credit card payments that equal, I don't know, like let's say $1,000 a month, so maybe $12,000 a year, then you would be able to say, okay, 12,000 divided by 90,000 is my ratio less than 15%. If it is, then I'm doing a fantastic job. If it's not, then I want to be able to get my debt to income ratio under control. And that is also just another aspect of your cash flow statement and how beneficial it can be for you. And the next two ratios that you could use your cash flow statement to calculate are called your front end mortgage and your back end mortgage qualification ratios. And we'll talk about each of them. So the front end mortgage is you'll take your annual mortgage, your payment, your interest, your taxes, and your insurance, and you'll divide it by your gross income. You want that number to be less than 28%. You don't want your mortgage to be more than 28% of your income. And most approval processes are going to have a number right around there. And even if you could find a lender who is willing to give you a home or a mortgage or a loan at a 35 or 40%, where your mortgage, your payment, your principal, your interest, your taxes, and your insurance is like 40% of your salary, that is a very difficult loan to be able to maintain. Like, you're putting yourself in a really difficult situation. And if you were to imagine from an underwriting perspective, the likelihood of you being able to achieve that monthly payment over 15, 30 years is not very high. So you're putting yourself in a high risk of defaulting on your mortgage, possibly having to sell your home in a short sale, or just dealing with other issues, right? Even if it's like, okay, I don't have any other debt, Dre, it's just my mortgage. You're gonna want to do things. You're gonna want to travel. You're gonna want to put money away for your financial freedom or your mortgage. There's things that you're gonna want to do. You may have kids. Like, there's gonna be expensive with the house where you have to be able to pay for like your AC when it goes out, or the lighting when it's like crazy. Or I remember one time, like, I'm big on fixing things myself. So I remember one time I was putting in a new faucet and a new sink, and I did not know what a CPVC pipe was. Not a PVC, but I think a CPVC. It's an old pipe that they used in the 90s, and the reason that they stopped using it is because the pipe is very cheap and it's a very like usable plastic, except when it gets wet. Which, of course, you and I are like, well, that's what we're using the pipe for. It's going to be wet. And so because when it gets wet, it gets brittle. And so if you ever try to unscrew it, it just snaps. It just completely breaks. And that happened. And I flooded. I like flooded a whole part of my house when I did that. And of course, my wife was looking at me like, "You idiot. I can't believe you did that." And I was trying to explain to her that, well, it wasn't a PVC pipe. I didn't do anything wrong. It just literally snapped. And eventually I was able to look it up, and I found this video, and it was like, hey, if your pipe is this vanilla color and not white, then that means it's CPVC, which is a very brittle pipe, and you have to use a handsaw. So you cannot use any other tools because it's just going to break off. You just cut it with a handsaw. Everything else will break it. And so I went through that and I learned that. So you're going to have issues that come up. And if it's already 40% of your mortgage is going to just pay for the house, then you're going to be literally praying that nothing happens ever. Because if it does, you're going to be in a rough spot. You can't put money away for emergency fund. You can't really do a lot of the different things. And so that's why it's good to be around 28% or lower. Really, if you can be lower than 25%, even better. But 28% is like a good safe spot. And then the last ratio is your back end mortgage qualification ratio. And that's just your annual mortgage and credit card payments divided by your gross income. Realistically, if you have a mortgage and you have credit card payments, then you got to pay them anyways. So if that number is greater than 36%, then you're in trouble. If you want to have your credit card payments and your mortgage together, then that needs to be less than 36% of your income. You already have where it's just the mortgage by itself needs to be less than 26%. So we're going to give you 8% to be able to allocate of your annual salary towards your credit card payments. If the two of them combined brings you over 36%, then again, you've just set yourself up for a very difficult situation, because one is you don't have really enough money to make more than the minimum payments, which means you're going to be paying the credit cards for a very long time with the extra interest. So your money is not being allocated as efficiently as it could be. And you find that any change in your financial situation, in your life goals, that any shift you want to make, it's very difficult. You can't just leave your job because it's so tied to you being able to make the mortgage and the credit card payments that you can't make really any shift, that you can't even take the smallest pay cut, because if you do, you'll be filing for bankruptcy essentially, or at least you'll be very stressed dealing with all of the other payments and things that you have. And I get it. Some of the lenders out there are very creative in ways that they can get you an approval, but you don't want an approval if it's not going to work for you, because when you default on your mortgage and the bank comes in and they buy it for pennies on the dollar and then they get to sell it again, it's just not a good experience for you. I remember there was one time that my wife and I were looking for a home, and it was during a time where there was a lot of short sales, like right after the recession. And this particular house that we loved, and we put in an offer and they accepted it. Well, during the process, we found out that the home was closed on by one lender, and then the other lender like bought it, and so they were willing to short sale it. And so both lenders ended up having their name on the title, and we just couldn't figure out how to get that clear so they could even sell the home. Obviously, eventually they got that figured out, but my wife and I, we had to move on. We couldn't just wait on that, and we did. We waited for several months, and you'll find that it just gets very ugly. It's very difficult to have a plan that requires a perfect situation, because that's just not going to happen. There's going to be a recession. There's going to be a dip. There's going to be a crazy pandemic. There's just going to be something that happens, and you want to give yourself that breathing room so that you don't have to lose everything as a result. And there are plenty of ratios that we can use to determine whether someone's in a good financial situation or not. But I've given you 5 cash flow statement ratios that you can use to be able to say, am I putting a good financial plan together? Am I putting myself in a good financial situation? And you'll see that whether you have a cash flow statement, you have a balance sheet, that the same way that you can use a cash flow statement or a balance sheet to evaluate a stock or a company on Shark Tank, things like that, you can use the same statements and ratios to be able to evaluate your own personal life and your own personal financial situation. And it's a great first step in your financial plan. If you like the video, I ask you to like and subscribe, and feel free to check out other Wisdometric videos if you're looking for ways to eradicate financial stress, generate passive income, and build a prosperous retirement strategy.